I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Look, my friends. Hey, I'm just trying to make a little money here. My job is just entertainment. I'm going to be doing some explaining. So call me at 1-800-743-CBC. Tweet me at Jim Cramer. Look, you either believe or you don't believe. It is as simple as that. You either accept that OpenAI is going to pay for the billions of dollars of chips they just ordered from AMD, or you refuse to believe it, and you assume AMD will get stiff because OpenAI doesn't have the money or won't need the chips. I prefer to accept the answer I got on a squawk on the street this very morning from Lisa Su, the brilliant CEO of AMD. She's not worried, and neither is Greg Brockman, the co-founder and president of OpenAI. He will be doing the paying. Even though there are countless AI skeptics, the market clearly believes that OpenAI can afford to spend tens of billions of dollars on AMD's highest-end chips in addition to NVIDIA's chips, which is why AMD stock shot up 24% today, igniting almost the whole market. The Dow dipped 63 points, S&P advanced 0.36%, and the Nasdaq jumped 0.71%. That's where the action is. I know that I am a believer. Ever since Jensen Huang, the CEO of NVIDIA, told me about the possibilities of accelerated computing and artificial intelligence, 2018, I've thought that there could be some sort of revolution going here. Jensen told me I was thinking too small. He said it was actually going to usher in the fourth industrial revolution. Now, initially, I thought that seemed a little bit hyperbolic. We've had three industrial revolutions. First, there was the steam engine and the rise of machine production. Second, electricity and mass production. Third, the last 5 decades of digital technology, automated production, electronics, telecom, the PC, and the internet. And now is the fourth industrial revolution, the era of artificial intelligence and machines that reason. That is the next iteration. Machines that we'd rather deal with than humans. Machines that will either be our assistants or our enemies, if you believe Hollywood. I see no reason to disagree with Jensen Huang. His predictions have been right the whole time. He predicted AI would be seismic and his company would be at the heart of it. Today, though, we found out we have a second heart with OpenAI, the most aggressive of the generative AI plays, stepping up to the plate and announcing a gigantic deal with AMD to supply cutting-edge chips, the kind that rival what NVIDIA is making. Rival. I found it shocking. I knew that AMD was working on chips that could compete with NVIDIA's. I knew that for a while. OpenAI's Greg Brockman told us this morning that he basically needed all the computing power he could get his hands on. And AMD's product was excellent. OpenAI will be taking a stake in AMD, a slug of warrants, which kick in as AMD's stock goes higher. This deal could be worth tens of billions of dollars to AMD and Lisa Su. Now, the stock market lapped it up with AMD rallying $39 or nearly 24% in one session. But more important, all the parts of the data center went higher. The usual suspects, Dell, ARM, Marvell, Micron, and the more prosaic companies that design and build the centers. They all had still one more rally in them. Any good news about this particular part of the economy sends everything connected to it roaring. But what matters to me is that there's a never-ending parade of billionaires, hedge fund managers, and their journalist mouthpieces who simply will not relent. They refuse to accept that all this is happening, and it is happening. They think these sky-high levels of spending have to lead to a crash, not unlike the dot-com implosion in the year 2000. Oh, they got the same old litany. The spending will get more reckless and more reckless. Companies involved more and more. They'll trade based on alchemy. The transactions be phony. Lazy Susan deals where you give me $10 million investment, I give you 10 million orders, or 10 billion and 10 billion. Just a table and a swivel. It sends you the money, and then you send it right back. Yes, that's a Lazy Susan sale. These critics are so confident that they can make you feel like a fool for trying to make money this way. They act as if the gains in the AI stock somehow don't count, like you have no right to them, because someday, they're going to go away. Now, I've been wrestling with these naysayers and pessimists for all my working life, all the way from Dow 1,000 to Dow 46,700. And it's incredible what magicians they are. They can still make you somehow feel foolish for buying stocks and me for recommending them. you can bet they don't believe in the fourth industrial revolution. They think it's all snake oil. I talk about this endlessly and how to make money in any market, just endlessly, that these people have kept. These are the people who have made you so you can't make a lot of money. The billionaires, they come on, they have the money, and it's almost as if they don't want you to make the money. No, it's like they don't want you to make the money. But let me tell you just how wrong they are, okay? Last month, Jensen Huang won a very similar deal with OpenAI, this time a 10-gigawatt deal. The AMD was 6, with the latest and greatest NVIDIA merchandise. Unlike AMD with its grant of warrants to OpenAI, NVIDIA actually is going to be investing $100 billion in OpenAI in stages over the life of the deal. If you haven't studied Jensen's moves, you might not know that he's an excellent investor. He does all the work himself. I'm telling you, I have people who've been in the room. He intimated that rather than this being a circular lazy Susan deal, as the billionaires described and the hedge fund shorts described, it's simply a great investment in an up-and-coming company. He pointed out that there can be no circular deal if there's no quid pro quo. No matter. I hear from people immediately, ones I haven't talked to in years, who are outraged that I believe that Jensen, when he said that the deal wasn't exclusive. This guy has created $4 trillion of market capitalization in less than 5 years. Why the heck wouldn't I believe him? Of course, I heard from none of those critics today when we found out that it really wasn't exclusive, to the point that where OpenAI seems to view AMD's chips as equal to NVIDIA's. I mean, I found it a little insulting. They needed computing power to meet the demand because the demand is overwhelming them. I asked how they were going to pay for it, and they told me basically not to worry about it. But they have a no-nonsense CFO in Sarah Fryer, a storied fixture at young companies and former managing director at Goldman Sachs, whom I trust through and through. And AMD's Lisa Su is one of the toughest execs in the business. Both have impeccable credentials. But look, what can I tell you? I trust them. I mean, what am I going to do? That's all I can tell you is I trust them. In 1999, though, well, there was nothing but shysters and crooks and liars and mountebanks right at the top of the big companies. As the founder of TheStreet.com, I know wherever I speak. The executives running OpenAI and AMD are not like these people. The current iteration, are honorable. The people back then had nothing to do with the people right now. I take offense when people question what Jensen's doing. I really do. But what's the hurry here? Aren't the hyperscalers worried that the equipment they're buying isn't worth it? That they might go broke spending all this money? That by the time they get the equipment, it is going to be obsolete? No. That's not what they're worried at all. In part because the hyperscalers all have very deep pockets. They don't care about the cost. In the end, they're afraid of being the next Microsoft. Bing! Left in the dust. Left behind. See, each one has its own verticals that need AI. Meta has social, ads. Tesla has robotics, autonomous driving. Google has search. Microsoft has the enterprise. Amazon has retail. They're all deathly afraid of someone else coming in to take their business. After today's announcement by OpenAI, I think they're right to be afraid. They're right to keep spending. They have to. And that's what OpenAI's partnership with AMD is all about. They want to challenge every one of these verticals. They need every bit of computing. They need both NVIDIA and AMD. Oh, and what do I think about the stock of NVIDIA here after this OpenAI deal with AMD? Oh, nothing's changed. It's just like the second industrial revolution. I always knew there would be another railroad. Here's the bottom line. The hyperscalers are all vulnerable if OpenAI gets this computing power. And given the number of chips it's buying, I think this company can go after everybody's business. No wonder the hyperscalers are spending so aggressively, too. If they stop, they're worried about OpenAI. Well, let me just say, OpenAI will eat their lunch. And I've got to tell you, those guys are tough enough that I believe them. Let's go to John in Indiana. John.
Hi, Jim. How are you doing today?
I am doing well, John. How about you?
Good, thank you. First-time caller, long-time listener.
Excellent.
I have owned this stock for 2+ years. Do I take my 65% profit or let it ride? Bank of America.
Let Bank of America ride. It's very inexpensive. I think it can go much higher. I don't think it's going to be stuck at this level, and I like the way the financials trade very much. You'll do well with Bank of America. Stephanie in Colorado. Stephanie.
Hello, Jim. Thank you for taking my call.
Of course, Stephanie. What's up?
I am calling you about a great little company called Celestica from Canada.
Did you see that stock today? Did you see how beautiful that stock acted? Holy cow. I mean, and J-Bill was acting not nearly as good. I think J-Bill's a good company, but Celestica, they better come on. I mean, that thing is just like that's a freight train. Let's go to Wesley in California, please, Wesley.
Jim, bought the book. Sorry I couldn't make it to 555 Fifth Avenue, but I bought it on
no, you don't have to worry because they ran out of books. They ran out of books real early, so you didn't have to worry. You see, I didn't have any in my backpack, you know? But they ran out of them. That's okay. There's plenty of them where I came from. Sorry.
$14.95 on Kindle.
I don't play for dinner.
Easy peasy, Jim. Here's an easy one, Jim. Goldman Sachs, buy, sell, or hold.
Buy. The stock is selling at a ridiculously low multiple still. It's hovering around this level. People are getting nervous at this level. It's going to blow through this level, and you're going to wish that you got in right now. All right, look, this deal between OpenAI and AMD is a shot across the bow to all the other hyperscalers. Don't you see that? And I think they are right to be spending as much as they are to defend. And the billionaires who want to keep you in your chains, throw this at them, or at least make them read it. All right. Mad Money tonight. With the release of Grand Theft Auto 6 on the horizon, I'm giving you my take on the Take-Two Interactive story, and I'm revealing my cheat codes for this name. Then, what's behind the latest move in shares of electricity company Entergy? I'm taking a close look at that Louisiana powerhouse. And you called in and you stumped me with this Inspire Medical. I mean, what was that all about? Well, I did the work. I'm ready to give you my prognosis, so you better stay tuned to Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Even with the government shutdown, this has been a phenomenal market with so many stocks up huge for the year. But which ones can keep running? I mean, that's what we know. Maybe even away from the data center. All right, let me give you a big one. Take-Two Interactive. Buy. Yes, the video game powerhouse you probably know from their iconic franchises like Grand Theft Auto, Red Dead Redemption, and NBA 2K. In the past couple of months, this stock has really caught fire. It's now up roughly 40% for the year, in part because with EA going private, there's now a newfound sense of scarcity in the video game space. But mainly it's because the next installment of Grand Theft Auto, GTA 6, comes out next May. This is one of the biggest franchises of all time. Maybe not just gaming, but any form of media. Some could argue it is the #1 franchise of all time. Until that comes out, though, Take-Two shareholders find themselves in a weird limbo. How much do the results even matter with an almost guaranteed blockbuster on the horizon? Well, they matter if the numbers are good. Take-Two reported its latest quarter back in August, delivering a strong top and bottom line beat. Net bookings reached $1.4 billion, surpassing management's own forecast, as well as $1.31 billion number that Wall Street had predicted. As a result, despite being only one quarter into their 2026 fiscal year, management felt confident enough to raise its full-year forecast for both net bookings and earnings before interest, tax, depreciation, and amortization. That said, Take-Two's guidance for the current quarter came in a tad softer, but the quarter was still strong enough to keep the stock running. Plus, it's not like this is some tiny company that's doing nothing until the Grand Theft Auto company franchise puts out its new edition. This is one franchise among many. On the conference call, management highlighted the continued success of their NBA 2K franchise, the latest iteration of which already sold 11.5 million units. These sports video games are so terrific. You know why? Because they get to release a single new one. Every single year there's a new one, and people buy them. Even more impressive, daily active users climbed 30% year over year, signaling healthy engagement. This surge in player activity also fueled a 48% jump in, quote, recurrent customer spending, end quote, because increasingly the video game companies find all sorts of things to sell you after you've already purchased the game, usually in the form of add-on content. Now, many of Take-Two's titles are still rooted in PlayStation, Xbox, and the PC, but they have now rapidly growing mobile business, too, after the acquisition of Zynga 3 years ago. Under the company's peak mobile library, that's their label, Match Factory posted record net bookings, growing 33% year over year. Toon Blast also delivered another strong quarter, growing revenues 22%. It was very impressive given that it was up against some real tough compares. None of these, though, are Grand Theft Auto, and it certainly doesn't hurt to have a highly successful mobile business. And it's not just these casual mobile titles driving momentum. The mobile adaptations of Take-Two's core console games continue to perform, with WWE Supercard boasting more than 37 million downloads to date. Still, everybody's focused on GTA 6, and for good reason. The last GTA theft came out 12 years ago, and it's now sold more than 215 million copies worldwide. They've actually seen a pickup in Grand Theft Auto 5 and Grand Theft Auto Online, which saw new players' accounts surge 50% year over year. Not bad for a game that launched in 2013. At the same time, Take-Two's recent releases have been earning some rave reviews. Following the success of NBA 2K25, the newly released NBA 2K26 appears to be off to a very strong start. And we don't have the official numbers yet, but some analysts have been sifting through the available data, and what they found is pretty encouraging. According to analysts at Cowen, since an early September release, NBA 2K26 ranked number 6 on the PlayStation's most played list and number 11 on Xbox's during its first full week of release. That's a step up from the previous iteration, which peaked at number 13 on PlayStation, number 18 on Xbox. Plus, they also pointed out that Twitch viewership for the NBA 2K franchise is up 34% versus the previous quarter. For those of you who are my age, Twitch is where your kids watch other people play video games. Not sure I see the appeal, but then again, I'm not the target audience. Take-Two also mentioned that their 2K banner is working on a, quote, college basketball experience, end quote. Now, we don't have any idea what that would entail. But it's been 15 years since the last NCAA basketball video game. Could there be a lot of potential here? Hopefully the players can get paid. What else? A few weeks ago, Take-Two launched Borderlands 4, another big franchise that was apparently well received. Given that this franchise has sold over 90 million units, I got to believe it makes good money. But honestly, far more important than the latest earnings report is the simple fact that just last week, the old Electronic Arts announced it will be taken private at $210 per share by a consortium of private equity firms, including the Saudi Arabian investment fund, Silver Lake, and Affinity Partners. The leverage buyout came just 2 years after Microsoft acquired Activision Blizzard, the other huge American voice video game publisher. This was an industry with 3 major players, but now, with Activision gone and EA going private, Take-Two is now the only major publicly traded American video game company that's a pure play. Now, I think this is huge. Not only were some very sophisticated investors willing to pay a premium for EA, but Take-Two has real scarcity value now. If you want a traditional video game publisher, you either need to mess around with the Japanese market or bet on Take-Two. Sure, Microsoft and Sony have huge gaming divisions, but most of their sales come from other businesses. That's why I'm feeling really positive on Take-Two right now, even now, 8 months before the next Grand Theft Auto comes out. If you bought the stock 8 months before the last Grand Theft Auto in 2013, that would be in January 2013, and then you held it for the next 2 years, 133% gain. Here's the bottom line. Grand Theft Auto 6 is almost guaranteed to be a major hit. And in the meantime, Take-Two's already firing on all cylinders. And once EA goes private, it will be the only pure-play American video game publisher that's publicly traded. Just keep in mind, if you're taking the plunge into Take-Two here, you have to be able to stomach any delays to GTA 6. In fact, you should expect delays. Video games aren't like movies, which come out on a regular schedule. But I'm so confident in Take-Two that I actually hope that the next big game gets delayed and the stock comes down hard, which would give you an even better buying opportunity. Mad Money's back after the break.
Coming up, the lights are on and the servers are humming. Cramer on why data centers may be lighting up energy's future. Next.
We need to talk about this incredible run in Entergy, the New Orleans-based electric utility, which has seen its stock move up from 87 to 97 in a month. I mean, come on. Including some big moves just over the last 2 sessions. So Entergy hit a new all-time high today, which has become a semi-regular occurrence these days, with the stock now up more than 28% year-to-date. Mind you, this is a utility stock. What's driving this latest leg higher? Okay. Last Thursday night, Entergy announced that its Arkansas subsidiary will be powering Google's new $4 billion data center in West Memphis. This is just the latest example of a regulated utility catching fire thanks to some new AI data center announcements. Yep, these sleepy utilities have done something incredible. They've become growth stocks. When you hear me talk about regulated utilities, that means the profit margins are basically fixed by state regulators. Regulated utilities are allowed to raise the rates gradually over time, but it's an arduous process to submit requests and obtain approvals. So really, if these companies want to grow, they're not going to grow from pricing. It can only come from additional demand. Fortunately, these energy-hungry data centers have caused an unbelievable spike in demand for electricity. After aggregate U.S. electricity consumption was effectively flat for 15 years, from 2005 to 2020, the U.S. Energy Information Administration estimates that electricity consumption should grow at about 2% from 2020 to 2026. And many estimates now have electricity load growth more than that headed into the end of the decade. I think it could be as high as 5%. Now, this is hardly a news story. The independent power regulators, the producers, the non-regulated utilities that produce electricity and then sell it to the highest bidder. Oh, man, well, you're familiar with them. You've seen them. Their stocks have roared. Here I'm thinking about Constellation Energy, Vistra, Energy, and Talon Energy. Ever since ChatGPT launched near the end of 2022, most of these are up between 315% and 825%. But it's taken longer for Wall Street to realize that this theme is so big that it's turned the sleepy regulated utilities into winners, too. Take Energy, which I've been recommending for a while. This company held a bullish analyst meeting way back in mid-2024, where management detailed how data centers, as well as liquefied natural gas terminals, some other industrial end markets, were driving elevated demand for power in their coverage area. We last spoke to Energy CEO Drew Marsh a little less than a year ago, and he was almost giddy at the scale of the opportunity here. At the time of the interview, Marsh teased the large forthcoming customer. And just a couple weeks after that conversation, we found out that the customer was Meta Platforms, which is building a $10 billion data center in Louisiana. That sent Energy stock flying, and it has not looked back since. I said, look at her, even after this magical run. Sure, Energy now, look, it's a tad expensive here, trading at 25 times this year's earnings estimates. I'm not used to paying nearly that much for electricity, but I'm willing to pay up for a dependable company with accelerating earnings growth. Plus, the stock's actually going to look cheaper forward. It sells for roughly 22 times next year's numbers. And I expect more data center announcements that will send this thing higher and then higher again. It's got some nuke, too. It'll take many years for these to pay off. But again, this is the first time in decades that the regulated utilities have had anything remotely resembling a growth story. There are plenty of other regulated utilities with similar dynamics. Take Dominion Energy, the Richmond, Virginia-based utility that operates on the East Coast down to South Carolina. Not long ago, Dominion was a bit of a troubled company, spreading itself too thin with major investments in renewable energy generation, including a very costly offshore wind initiative that turned into a quagmire, along with some unwieldy natural gas assets. But the story has been simplified significantly over the past couple of years after management reined in the renewable investments and simplified its business, including with the sale of 3 gas distribution businesses to Enbridge for $14 billion last year. Ever since that Enbridge deal closed last year, Dominion's just been a juggernaut. The company now has a much cleaner story, one that's centered around providing a dependable, growing supply of power to many data centers in Northern Virginia. According to management, their total data center power capacity under contract has almost doubled in just over a half a year. Best of all, the stock sells for 18 times this year's earnings estimates with a hefty 4.3% dividend yield, so cheaper than Entergy. Even some of the nation's largest regulated utilities are finding that this theme's a needle mover. Like AEP, American Electric Power, the Columbus, Ohio-based utility that maintains the nation's largest electric transmission system and is also one of the country's top electricity producers. AEP's had a tremendous run this year with a stock up 25% year to date, thanks to low growth in the data centers, and that's hiding right in your plain face. It's so big. We should all have figured it out. When American Electric Power last reported in late July, the quarter was excellent. The stock jumped 4% in response. Now, some of that's because the numbers were genuinely strong, but a lot of it came from management's commentary about the demand growth they see in the future, driven by new data center customers, including Google, which announced a new $2 billion data center campus in Indiana, right in AEP's coverage area. So Google's helped out multiple utilities with its data center plans. On the last conference call, AEP said it now projects a staggering 24 gigawatts of new customer load by 2030, which was a 14% increase from what they forecast just 3 months before. That's how fast the story's moving. At the same time, AEP said its customers are actively looking to connect an additional 190 gigawatts of load to their system. That's roughly 5 times their current system size of 37 gigawatts. CEO Bill Furman called the load growth, quote, unprecedented. But he said that AEP is uniquely suited to address this challenge because it has such an advanced transmission network. We mostly don't have a great electric grid in this country, people, but that's nothing that AEP needs to worry about. Stock sells for just under 20 times this year's earnings estimates, solid 3.2% dividend yield. I am a big fan, have been for 20 years. So here's the bottom line. In the grand scheme of things, Entergy's new deal with Google to power a data center project in Arkansas is not that big a deal. But it's just the example of the latest one of many examples, because the AI data center build-out requires an immense amount of electricity, and that's turning regulated utilities into growth stories practically overnight. I like Entergy, Dominion Energy, and American Electric Power, all three. With so many data center projects, I wouldn't be surprised if the whole industry is a winner. Let's go to Randy in Washington. Randy.
Booyah, Jim.
Booyah, Randy.
First time, long time, won't be the last time. My
I hope so.
Oklo. My question's on Oklo. Opened a position early September at 72. 3 weeks later, it's at 140. So I sold half my position because, as we know, hogs get slaughtered. Pulled back to 110. It's on the move again. My question, should I buy now or hold for a better price?
You've got a really good position, and you don't mess with it. I was joking with Jeff Marks today. I said, why don't we just go buy some Oklo? I can't take it anymore. That's how I talk all the time. And he said, why would we do it? I said, because it just does nothing but go up. When you hear someone say that, even if it's me, I'll tell you what you do. You don't touch it. Let's just stay the course. John in Missouri. John.
Cramer, thank you for taking the call. Long-time listener, and I've done real well taking your advice, buddy.
Oh, thank you, boss. Thank you.
I got one here I'm kind of concerned about. It's EE, Exceligate Energy.
Yeah, I looked at that. I don't think you have. I mean, first of all, energy's in the wrong place to be. But second, that LNG terminal service, I thought it was going to be great because we don't have real deep water there. But I just feel like, after just reading the Rusty Brazil stuff, I just can't be excited about it. I'm sorry. I just can't be. All right, look, I like Entergy, Dominion, and American Electric Power. Those are like 3 huge ones. They're really easy. I think they're going to go up slowly over time. But with so many data center projects, I wouldn't be surprised if the entire industry wasn't a winner. Watch my man Monday, including my deep dive on a little-known medical play that you called about. Then with the government shutdown, where can we turn to get good data about the state of the consumer and the economy? I'm citing all my sources for you, and all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. Okay, so last Wednesday, I get this call from Andrew in North Carolina. I wanted to know about Inspire Medical Systems, which is a company that's come up with a minimally invasive procedure that's an incredibly effective treatment for obstructive sleep apnea, where your airways close up while you're sleeping. I told him I got to look into this one because anything related to sleep apnea has been eviscerated by the rise of the GLP-1 weight loss drugs from Eli Lilly and Novo Nordisk. After doing some research, I got to tell you, a few things in this business are more important than timing. Inspire spent years working on an incredible technology to replace the current standard of care for sleep apnea, a disease that impacts 30 million Americans, and it's linked to high blood pressure, strokes, heart attacks, and many other serious problems. For a long time, the standard of care here is a kind of face mask hooked up to tubes and a machine. It makes it look like you're on your deathbed, or, if you get one of the sleeker ones, it can double as a nice costume if you want to go as Bane from The Dark Knight Rises for Halloween. We've had rest men on the show many times, and over the years, they've made a fortune from these machines. But obviously, nobody wants to hook themselves up to a whole apparatus to get a good night's sleep. And that's where Inspire came in with just a brilliant idea. They implant a little neurostimulation device near your collarbone that helps keep your airways open, and the efficacy numbers for the latest model, they're incredible. According to the company, 91% of patients say it's better than the breathing machines. 79% report a reduction in sleep apnea events. And most importantly, 90% of bed partners report limited to no snoring. Gotta get one of those. Jeez. All right, anyway. Inspire first got FDA approval for the original system in 2014. By last year, it was already an $800 million business. Last summer, they received approval for their fifth generation model, which was even better than what they had already. Finally, Inspire looked like it could take a ton of market share from the CPAP machines and rule the sleep apnea business. Unfortunately, they were about a year too late because the GLP-1 weight loss drugs have proven to be incredibly effective treatments for sleep apnea. The number one cause of this condition is obesity. Now that there's an anti-obesity shot, every stock connected to sleep apnea has suffered. Inspire peaked at $330 in mid-July of 2023, and as of today, it's trading at $76 and change, a staggering 77% decline, mostly because Wall Street's worried that the GLP-1s will solve sleep apnea before too many people can benefit from Inspire's technology. Because CPAP machines are so cumbersome, and because Inspire's solution involves a surgical procedure, the first thing doctors tell anyone with sleep apnea is that they should go lose weight. Willpower. And losing weight's become a lot easier over the past couple of years thanks to GLP-1s, which are better than willpower. We first started to see GLP-1 concerns enter this market right around this time 2 years ago, with everything from packaged food companies to other healthcare names like Inspire taking a hit once investors began to suddenly price in what the rise of GLP-1s might have meant. Who knows? But while other sleep apnea plays like ResMed managed to bounce back from their late 2023 lows on better than expected earnings, Inspire kept sliding lower and lower. Why? Because ResMed's been able to report a series of good quarters. Inspire simply hasn't. Now, some of that's related to execution issues like a limited product recall last summer because of a manufacturing defect. The stock did get a lift when Inspire's latest device was approved by the FDA last August. But in the months afterwards, it gradually gave up those gains. The reasons for that are pretty messy. For starters, the new device hasn't been selling as well as they expected. At the same time, back in February, management disclosed they were cooperating with a kickback investigation by the Department of Justice. By the way, we haven't gotten any update on that issue since the initial disclosure. That news broke alongside Inspire's fourth quarter 2024 earnings report, overshadowing what was actually a pretty solid result for the company, with a much better than expected outlook for 2025. And in early May, Inspire delivered another better than expected quarter. But the last time Inspire reported in early August, the whole story fell apart. While Inspire actually managed a small revenue beat and a sizable earnings beat, nobody cared about that because management cut their full-year revenue forecast by 4.5% and slashed their earnings forecast by nearly 80%. That was devastating. After previously guiding for $2.20 to $2.30 of earnings per share, they now say it's going to be more like 40 to 50 cents. That's bad. The problem. Apparently, the launch of Inspire's next generation of sleep apnea implants simply isn't going that well. A lot of the surgical centers that install these things simply don't have the training to handle this new one. At the same time, there was a change to Medicare and Medicaid billing policy that made it impossible for the surgical centers to bill products until July 1. Management believes that they can turn this thing around now that most of the problems are in the rearview mirror, but the guidance was disastrous. On Inspire's latest conference call, CEO Tim Herbert gave a lengthy explanation of what is going wrong with the Inspire 5 launch, specifically calling out 5 different things that have hurt, including the ones I just mentioned. But the fifth and final factor was very simple. Listen to this. Quote, some patients may be delaying Inspire therapy to try GLP-1s, end quote. Management wasn't able to quantify the impact, and they continue to insist that GLP-1s will be a long-term positive, because tons of people are actually too obese to get Inspire's implant. They argue that the GLP-1s will increase their total addressable market by helping those people lose weight. I'm not buying this one bit. It feels like a crazy argument to me to make when you're cutting your earnings forecast by almost 80%. More importantly, these GLP-1s have proven to be incredibly effective treatment for sleep apnea, even before they make you lose lots of weight. Lilly Zepbound has already been approved as treatment for obstructive sleep apnea, and the others are all in clinical trials. In the end, I can't give Inspire Med my blessings. because it really does seem like the company's being hurt by the GLP-1s. Something even management's finally acknowledging. But look, it's not just the GLP-1s issue got a bad track record. They've had one execution issue after another after another. Their latest product launch was a nightmare. If you want to play sleep apnea, ResMed's been still putting up good numbers, which is why that stock's up 23% for the year. Here's the bottom line. In a world without the GLP-1s, Inspire might be a very exciting story. But that's not the world we live in. And from the looks of things, the GLP-1s may be eating them alive. Maybe this company can finally sort out its short-term execution issues and triumph. But I'm not going to hold my breath. Mad Money's back in for the break.
Coming up, Cramer takes your calls. And the sky's the limit. It's a fast-fire lightning round. Next.
Time to light welcome member of Black Quote the same name as talk later about the buy sell just regarding the questions I was my predict. And then the lightning round is over. Are you ready, Steve? Time for the light round question. Let's start with Tom in New Jersey. Tom.
How you doing, Jim?
I'm doing well. How about you, Tom?
From New Jersey.
All right.
I would like to have your opinion of Remitly Global, REL.
Well, that's to remit for immigrants to be able to remit money, and I think that is a very challenged group right now, and I don't think you want to be there. I'd rather just be in a traditional bank. Let's go to Edward in Texas. Edward.
Jim, my favorite person.
Oh, thank you, buddy. What's up?
I'd like to know, I've been doing homework, as you want us to do, and I'm looking at Upbound Group.
That model, that's the least owned model, has not been a proven model. I do not like it. I am sorry. Let's go to Gregory in California. Gregory.
Well, 2025 is turning into a magical year in more ways than one. Jim, congratulations on 20 years of Mad Money. Congratulations on your new book.
Oh, thank you, Gregory. I hope this is what, and I hope to get to see. Maybe you're there tomorrow. Are you here tomorrow?
I'm out
see
in the
you
West Coast.
That's right. That's right. All right. Let me help.
So I can't believe I'm asking you about this company. I mean, it really sounds like I sound like one of the companies you warned us about in your weekend piece for the club. Their balance sheet looked like, frankly, a word I can't say on television until very recently. But last earnings, they announced a $10.5 billion sale, greatly improving the balance sheet. Have I been drinking too much Phosphoro, or will Pope Cramer bless a small spec position in CommScope?
You know, I got to tell you, I think the real Gregory. I know that I feel awful that we missed the big run, but, you know, there may be another run in that one. I think that you're not drinking the Phosphoro. I think you're fine on that one. I know that sounds strange, but I really think you're fine. And thank you for the really great comments. Let's go to Frank in Texas now. Frank.
Hi, Jim. Today,
Frank.
I'd like your opinion on USAR rare earth.
Okay, now, we did a piece last week on rare earth companies, and we said that they're all speculative, but we recognize that the president at any given moment could take a stake. I am going to say that this fits that pattern, and we are not going to fight you to take it. Now, it's not like I'm just saying you can buy any one of these. I am saying that there's White House talk, Trump stake. That's what we're concerned about. You can play that. Remember, that's what you're doing. You're not playing the earnings, because there aren't any. Let's go to Carl in Oklahoma. Carl.
Jim, we Oklahoma Sooners appreciate all you do for us.
Oh, you're great.
Joshua.
Thank you.
And for our appreciation, we give you and the Eagles Jalen Hurts. I hope that's working out for you.
Oh, he's terrific. And he just needs a little bit more offensive coordination there, so to speak. What's happening?
The stock I'm talking about was recommended by the same guy that recommended NVIDIA back in 2015. It's Globit, GLOB, but it's not doing as good. What?
Call it GLOB. What the heck is that doing down there? I don't know why that stock's down like that. That's terrible. We got to do some work on that. I got to find Ben Stoner, research director. We got to find out what's the matter with Globin. Okay. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Wall Street's worried, but Cramer says the consumers still got cash. His take on the real state of spending. Next.
Every morning I start my day looking at what the research says. I know that might sound alien to you. I mean, who reads all the research reports to create an opinion? The answer's simple. I do. Today we got a lot of research about how the consumer's in terrible shape. I saw notes about how Shake Shack and Papa John's may be too expensive for some people. I've been a big fan of Shake Shack stock. I was surprised to learn that the customers are being hurt by the price of beef and a softer economy. Burger has gotten a little pricey, but I didn't think it was make or break. This morning, Matthew Boss, arguably the best retail analyst out there from J.P. Morgan, downgraded Abercrombie & Fitch and Bath & Body Works. You wouldn't do that if you thought the consumer was robust. Lots of these analysts choose to blame the government's shutdown and the idea that the president might use it to make a statement by firing a lot of people, going after the deep state. It's one thing to have 900,000 people not being paid as part of the furlough. That's the highest estimate. It's another thing to have a president that seems hell-bent on canning a lot of federal employees. You probably don't want to do a lot of spending if you think that's what's coming. Instead, you save, especially because there seems to be no resolution afoot whatsoever. That said, I'm sticking to my thesis that these shutdowns really do lasting damage to the economy or the stock market. Still, in the absence of actual employment data not available because of the furloughs, we really don't know our employment numbers. But the reason why I think the research is trending toward that way is exactly because they have a feeling that the number is going to be quite bad. Oh, and there's the lurking layoff machine that is artificial intelligence. We all know someone, including ourselves, who could be let go to make room for something like an Agentforce, the Salesforce AI platform. Let me tell you what I think. Right now, we're still seeing a robust economy as measured by the Atlanta Fed, with an economy, they're saying it's got a 3.8% GDP growth, according to the latest live forecast for the third quarter. We haven't seen any real shortfalls from any retailers, save Lululemon, which we know is very expensive. We've gotten terrific numbers from the cruise lines. And yes, I know that a cruise is a bargain relative to a lot of other vacations, but cruise reservations have historically dried up in other downturns. You don't take vacation if you're worried that you're about to get laid off. Meanwhile, we've had solid figures on bank loans and credit cards. In a real downturn, you expect a big surge in delinquencies and bad loans, but that's not happening. And then there's the most important indicator, the incredible merger between Comerica and Fifth Third announced today, where Fifth Third, a very strong bank, is taking on the Comerica Colossus. Now, Comerica doesn't have a lot of bad loans anymore versus the old days, but the stock's done nothing for years, which is not a good sign. Banks merge and take on other troubles only when they're so confident that they won't be acquiring a lot of bad loans. It's too risky otherwise. What a sign of strength. It is true that we've seen an increase in traffic at discounters, and here I'm speaking about a Costco or a Walmart or TJX, as well as the dollar stores. But I think the idea of value has become a constant of late. People are sick and tired of high prices after years of inflation. That doesn't necessarily mean, though, that consumers are in bad shape. The stocks that have been doing poorly in retail have been doing poorly for ages. We can't attribute the consumer's frugal behavior to any economic weakness because we've seen that same economic weakness for a while now. In short, the weak consumer narrative should be retired. Outside of Washington, I think the country's doing just fine. But Washington is a powerful enough influence that we may see and feel weakness that's not really there. And that's what I think the research is falling for. I'd like to say there's always a bull market somewhere. I promise to find it just for you right here on Mad Money. I'm Jim Cramer, and I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.